Hello, I'm James Yardley, Senior Research Analyst at Fund Caliber, and today I'm joined by Ben Griffiths, the Elite Rated Manager of the T. Rowe Price European Smaller Companies Equity Fund. Ben, thank you very much for joining us.
Morning, James, and thanks for having me.
Now, Ben, yours is a pan-European fund, so you invest in both smaller companies in the UK and in Europe. And I guess the big news at the end of last year was the Brexit deal. What impact has that had on your companies?
A good question, James. So obviously we're quite early into Brexit now being a reality for us. And my overall impression is that things have actually gone fairly smoothly. We're seeing a few, signs of friction in that trade. We've all seen stories about shellfish not being allowed to travel into Europe. But in general, we think things are really carrying on fairly well. The Brexit process was a very long process, as we all know. We all lived through it, and it dragged on for seemingly many more years than it needed to. That would have been bad for uncertainty, definitely, but that has been, of course, very good for allowing businesses a lot of time to plan for when Brexit actually happened. So when I think about our exposures in the fund, the first thing is that we don't have a lot of businesses that are kind of directly linked to that kind of cross-border trade between Europe and the UK in physical goods. And the second thing is that those businesses which have been exposed to those trade routes have had a lot of time to adjust. I would caution that we're waiting for kind of maybe first quarter results where we'll see the impacts.
And also, we see that Europe's actually sort of lagged the rest of the world at the start of this year. Has that got anything to do with it, or is it other factors?
I suspect that the Brexit process has probably definitely contributed some uncertainty, which is not good for markets. But I doubt that's been the overwhelming factor here. I think probably what we're seeing here is the fact that in Europe we've dealt with the pandemic and the virus okay, but maybe not super well. If you look at Asian markets, they've had a much better experience of dealing with the virus, and in many cases their businesses are back to full power, and their markets are doing very well. And then if you look to the West, to the US, although they've not dealt with the virus very well either, sectors of their market have done extremely well, and that's led to the US markets doing well. So I would suspect that we're more stuck in the middle there between dealing with the virus and having a lot of the really high growth sort of internet names that have done well in the US.
Yes, and we probably should say as well that although Europe has lagged at the start of this year, I know your fund has got off to a strong start. It's early days. We're recording this on the 10th of February, but I know you've had a strong start to the year. And I think you've got about 38% of the fund currently in the UK. Is that a normal weight, or is that higher or lower at the moment? Are you seeing some good opportunities then because of perhaps some of the uncertainty in the UK?
So over time, when we look at the UK weighting in the fund, we typically have been a little bit overweight. So the index weight is around 30% at the moment. We're close to 10% overweight. That's higher than it would have been in most periods, but we would generally have had an overweight to the UK within Europe. I think it's an important point to make here that we don't target the weightings of countries as part of our process. It's very much finding the right underlying companies to invest in and building them into a bottom-up portfolio, and then using our risk assessment to work out if we have too much in one particular country. The second point would be that although we do have a big overweight to the UK in terms of the weight of the fund, I don't think we have a big overweight to the UK domestic economy within those exposures. And we can look at that by looking at, for example, the UK sterling weighting of revenues, which is kind of in line with the index, which means that we're investing in a lot of companies that are not necessarily UK domestics, but they tend to be more global businesses, maybe healthcare, tech businesses, mostly in the kind of knowledge economy, where we do find attractive opportunities. So, yeah, the fact that we've gone more overweight is driven by the fact that we're finding more of these types of names. I would highlight one really successful area for us in the last year has been computer gaming, where the UK has a kind of strength in computer gaming companies. We've held a number of those in the fund, and they've done very well. In fact, one of them's currently being taken over. It's called Codemasters, which is a computer gaming company very exposed to the racing car genre. And they own, for example, the Formula One racing game, which goes out every year when the new Formula One season restarts. It's been very, very successful. It listed a couple of years ago. We bought it at the IPO in the portfolio. And towards the end of the last year, a bidding war erupted for this between Take-Two Entertainment and EA, the two of the big US computer gaming giants. And they really want to buy this niche exposure to computer, car racing, where Codemasters are the experts. So it's been a fantastic investment for us. But we've had up to 4, 5, 6 different computer gaming stocks within the portfolio over the last year, and they've all done very well. So this has been an area of success for us.
And do you invest in many emerging European companies?
We do not invest in a lot, is the answer to that. We have a capability within the fund, guidelines to invest up to 10% in what we call emerging Europe. We've very rarely invested more than a couple of percent of the fund in this area. At the moment, it's 1%. But we do think we want to have that opportunity because, this is a large, still a pretty large opportunity set for us. And we believe that particularly if some of these economies develop, there could be big opportunities here for us to create alpha for our investors over time. The names we do have at the moment are really quite exciting. They're both Russian exposed companies. The first is called Headhunter, which is a online recruitment company in Russia. And this is a pretty youthful market, I would say, in Russia. It's nowhere near as well developed as most places in the world. But this company, Headhunter, is by far and away the leader in online recruitment. And the second one we have in emerging Europe exposure at the moment is even more exciting, arguably. It's called Ozon. It was a recent IPO in Q4 last year. And this is effectively the Amazon of Russia. They're a marketplace and e-commerce business. Again, we think these are the leading player in e-commerce in Russia. Again, much earlier in its life cycle than Amazon is, or many of the companies in China, for example. And this company has, apart from the great positioning and product range, it also has really good distribution, which if you think about a country like Russia, is really important because Russia spans 10 time zones and is absolutely gigantic. So being able to actually distribute the goods to your customers is a really key differentiating factor. So yeah, those are our current bets in emerging Europe.
And a lot of people are wondering if they're going to be able to go to Europe for their summer holidays. Do you have any companies in the portfolio exposed to travel, exposed to maybe a rebound in that area? What's your sort of view at the moment?
Well, I really hope we get back to normal as quickly as possible, and I would really like to have a holiday. My view is that we are going to return to normal. It's probably going to be, measured, slow return, and there will be very different speeds between different parts of the economy. The obvious area there is I do think that probably leisure travel will return much faster than business travel will return. But regardless, I think that as soon as people feel safe, there's a massive pent-up demand for people to want to go and visit places, and in many cases visit family that they haven't been able to see for some time as well. So we do believe that the vaccines are going to gradually get us out of this. Obviously we don't know what's around the corner, and this pandemic has been surprising us every few months. But given where we are now, we do think things will reopen. So in terms of our direct exposure to kind of travel names, we don't tend to own stocks like airlines because they don't really meet our kind of quality criteria for what we look for. But we do have a couple of names. And the one I'd highlight would be SSP Group. It's a UK name, but they are actually a global leader in kind of food retailing within travel. So they own lots of the different formats at both railway stations and airports across the globe. And then we do have another interesting UK name called Trainline, which I'm sure most people will have come across, the app for booking train tickets in the UK. We've also been added to this one, and this will obviously hedge us if we can't travel abroad, but we can maybe start traveling around the UK and people can start using the trains again and go back to work, hopefully. And this is a really great asset. They've built a fan app with great functionality, and there's a massive tailwind here as people are encouraged to use digital tickets rather than paper tickets, and do it on your mobile rather than go to the booking office and the train station. So we think that Trainline has a very long runway for growth, and we get an opportunity to buy it now because we're in the middle of this pandemic and nobody's allowed to get on the train at the moment.
Very interesting. And just finally, have you got another couple of your best ideas you can share with us?
Yeah, no, definitely. I think the whole portfolio is, I think, looking quite exciting at the moment, but there may be one or two I'd highlight. Our biggest holding right now, so this should be one we're most excited about, is called Shop Apotheker. And this is a German company, and it's essentially an online pharmacy business. And we think this is very exciting. The German market is a strange market in that all the pharmacies are still owned by single pharmacists. So the ability of this company to come in and offer a national online service is quite appealing. Obviously, the pandemic has helped Shop Apotheker because nobody wanted to go to a pharmacy to get drugs. They wanted to go online, so it's accelerated adoption of their services. Also, the government has mandated electronic prescriptions to be used, which is a boost for this business in the medium term. But the really exciting thing here is that this is just such a young market still. So Shop Apotheker is probably going to do about €1 billion of revenues in the current year or the year just gone. The opportunity in Germany alone is a €40 billion opportunity. And they've also got positions in most of the other European countries as well. So that the total opportunity here is multiples of where they are. And we think that they're also the best place to win this market. Their focus on the app and the consumer experience is streets ahead of their competitors. So we think this could be a much, much bigger company over time. And if you look to markets like the US or Sweden, for example, and Sweden has 10% penetration of prescriptions online. In Germany, it's 1%. In the US, it's much higher than that. I think close to 30%. So, it's an obvious category to go online, and we think that these guys are in the pole position. And the second one would be MIPS, which is one of my long-term favourites in the portfolio. It's a Swedish business, and they make a helmet safety system. It's essentially something you add to a helmet to prevent rotational injury if you fall off. And they've been very successful. They are the dominant player in this market. The really good thing about this business is that it's what we call an ingredient business. So, they don't have to make the helmets. They just make a very small insert that goes into the helmet, charge sort of $5 or $6 to the helmet producer, and then they get their brand onto the outside of the helmet. So it's a little bit like Gore-Tex is in outdoor clothing. It's something that you just add. And that means that this company can make margins which are very high. They're already very high, but we think that they can become even higher. Currently, they've done very well in cycling and skiing and other sports helmets. However, they're currently increasing their addressable market by going after things like safety helmets in construction industries or the military, etc., which are actually much larger markets in reality. So if they can really make headway in these markets, it'll be very exciting.
Brilliant. Well, that's been really interesting. Thank you very much, Ben, for sharing your thoughts with us today.
No problem. Thanks a lot.
And if you'd like to learn more about the T. Rowe Price European Smaller Companies Equity Fund, please visit fundcaliber.com.